So what could happen is that the Dow in theory doubles to, say, 20,000, or even goes up 4 times to 40,000, and the dollar then declines to the same extent or more than that, and that in real terms you would lose money by investing in the United States.
The Nikkei gave many false buy signals during its epic bear market. What are your thoughts, Mark? Because you addressed this in the letter briefly, but some are claiming there are buy signals now in the Dow. What are your thoughts on that?
Well, to some extent, there has been a buy signal on the Dow. And I believe that path of least resistance is for the stock market still to go up. But we had a huge move, 666 to 1,000. And it wouldn't surprise me to see here a 10 to 20% correction in the market before we go higher. But as I said, I don't think that the market will go up because of favorable economic fundamentals, but I think it will go up purely because of money printing.
This money printing you keep talking about, and we're seeing maybe some speculation going on in markets. Let's talk about the Chinese stock market, because you did mention that. Is there excessive speculation going on in the Chinese stock market?
Well, my concern is that we had excessive speculation in NASDAQ 1998 to 2000. We had excessive speculation in real estate worldwide between 2001 and essentially 2007. We had excessive speculation in commodities in 2008. And we have again excessive speculation in everything worldwide, basically because interest rates are at zero. So when interest rates are at zero, the pensioners and people that have large cash holdings, they don't earn anything on their savings, and they are forced to essentially become some kind of speculators or momentum players. And if the markets go up, then they pile in. And if the markets go down, they try to go back into cash and so forth and so on. And that then leads to a very high level of volatility.
You noted the Alan Newman chart showing extremely, record high speculative intensity not seen in the NASDAQ, the bubble in 2000. So we are seeing excessive speculation in both China and the U.S. I guess my question for you here, Mark, is, and I talked with Jeffrey Stout about this, the chief investment strategist from Raymond James, but back when we were around 8,000, he said we'll just keep going and melting up simply because of the fact that these various pension funds, as you alluded to, and some of these other types of holding companies will be forced to essentially take their underweighting of equities and basically go back to an equal weighting or some type of measurement that will force these funds back into the stock market. So this is just a liquidity-driven rally, and which is what you're pointing out. What happens when the liquidity stops flowing? Do we get the bottom to fall out of this thing?
Yeah, that's a very good point. In an environment such as we have, where the central banks around the world, and this is not just the Federal Reserve, but all of them do it, when they print a lot of money, when this money kind of has a huge impact on liquidity, and liquidity expands, and asset prices go up. And then there is a certain point when, for a variety of reasons, liquidity tightens again somewhat, and you have huge downward moves in asset prices. And then more liquidity is injected on this downside move, and you have again huge upside moves. So what you have is huge volatility, and that makes it a very challenging environment for investors.
I know you're looking for a bounce in the dollar here, and you talked about that. What do you see as the possibility of a dollar bounce in terms of what kind of traction might we see here on the dollar?
I think the U.S. dollar can rebound. I'm obviously not bullish about the U.S. dollar in the long run, and we would have to also define about being positive about the U.S. dollar against what. I think the dollar is a lousy currency in the long run. It will continue to lose its purchasing power, but the other currencies are not much better. We had very close correlation between asset markets. Asset markets went up between 2002 and 2007, everything, commodities, stocks, bonds, real estate. And during that time, the dollar was weak. And then 2008, all asset markets went down and the dollar was strong. And then starting March 6, stocks rallied again in the U.S., the S&P from 666 to over 1,000 recently. And the dollar began to weaken again. So a strong dollar means basically that global liquidity is tightening, and that is bad for asset markets, whereas a weak dollar means that liquidity is increasing globally, which is good for asset markets. Now, we had this huge rally in the S&P and other markets around the world, and I think that if I look at the big picture, we have today markets that are overbought, very overbought in some cases, like China recently was. It now went down 20%. And the US dollar has really no friends left. I mean, everybody is very, very bearish about the US dollar. And I think we could come into an environment where global liquidity tightens again somewhat and asset markets correct in the order of 10-20%, and the dollar has a rebound.
And Mark, you stated recently that you believe America will launch more wars to distract from the bad economy. Is that sum it up?
Yes. I mean, this is something many people misunderstand. They believe that when you have an output gap, in other words, when you have large excess capacity, there is little inflation. And when you have tight markets and a strong economy, inflationary pressures come up. But I have a different view from observing the historical evidence. Usually in very weak economies, the tendency is for governments to create large fiscal deficits and to print money. And then despite of a large output gap, in other words, the economy operating below its potential, you have inflation. And every government in the world over time, in order to bail out the system, has inflated essentially. And when that doesn't work anymore, and it never works in the long run, it only works in the very short run, then in order to distract the attention from its shortcomings, governments then engage in wars or in some kind of an action that distracts the attention, that involves acquisitions of foreign territories and so forth. And so I believe that the war tensions are increasing in the world.
All over the U.S., European, and Asian news, they are touting the end of the recession. And I talked to John Malden about this. He talked about this being a jobless recovery. But are they premature to celebrate, Mark, in your opinion?
Well, basically, the economy fell off a cliff between last September and March of this year. And then we had the impact of money printing and the growth in the fiscal deficit kicking in, and that stabilized the global economy. But I have to stress that if you increase money supply at, say, 10% per annum consistently, and you then go to a growth rate of 30% annually, it has a temporary impact. The same is with the fiscal deficit. If you have a fiscal deficit of $1 trillion and you increase it to $2 trillion, it has a temporary favorable impact on the economy. But in the following period, unless money supply accelerates from, say, 30% per annum to 50% per annum, if it just stays at 30%, the favorable impact is neutralized. Similarly, for fiscal policies, if you have just a deficit of $2 trillion in the second period, in other words, the same as in the previous period, then the stimulus is just there to keep the altitude of the economy, but not to lead to growth. In order to essentially further stimulate, you would have to go to a deficit of, say, 2.5 or $3 trillion. In other words, you have to continuously increase money supply and fiscal deficit. And I think that we had this impact in starting March and lasting about until now. And now the impact of easy monetary policies and money printing and the fiscal deficit is going to start waning. And therefore, I don't believe that the recovery will be very strong. There can be a further bounce in economic activity, but that essentially economic statistics will continue to disappoint, and that we could have a further downturn in economic activity manifesting itself, say, in the fourth quarter of this year or first quarter of next